Hello, everyone, and welcome to today's Montreal Exchange Options Education webinar. I'm David Chirizono. I'm the Marketing Director for TMX, and I'll be your host for today's session, which is our second webinar in our Options Education series. I'm very pleased to have you with us as we explore selling cash-covered puts, a strategy for investors to use for potentially generate income. Before we begin, I just want to have a quick reminder here that today's session is for educational purposes only, and it does not constitute as investment advice. The opinions shared here are those of the presenter and not necessarily represent the views of the Montreal Exchange or its affiliates. If you'd like to continue learning after today's webinar, I encourage you to visit the Montreal Exchange website in our option education section, where you will find tools such as the options calculator, the trading simulator, and additional strategy resources. Just as a reminder, you can submit your questions anytime through Slido, and we'll address as many as possible during our Q&A portion at the end of the presentation. If you'd like to revisit the content and a replay of today's session, it will be available on the Montreal Exchange website shortly after the event. So now it's my pleasure to introduce again our speaker, Chris Thom, CEO and Portfolio Manager at Moat Financial. Chris, welcome, and thank you for joining us.
Thank you. I'll bring up the deck here, and I appreciate everybody who has joined us today. If you can just confirm that the slides are showing, please.
Yes.
Okay. So appreciate everybody coming today to talk about selling cash-covered puts. Cash secured puts is another name for these. Those are very interchangeable, but it's a great strategy, and really, I think the most encouraging next step in option trading for anyone who has been involved with covered calls. This is the disclaimer for the Montreal Exchange, which David already touched on, that this is for educational purposes only, and some of the tools that are available on the Montreal Exchange website for calculating trades and just enhancing your ability to trade. So a bit of a disclaimer from Moat Financial that, this is just for educational purposes. And, before you execute anything, make sure you understand what it is that you're doing or seek out the advice of a professional. So a bit about me, if you're not familiar with who I am. My name is Chris Thom. I'm the CEO and Portfolio Manager at Moat Financial. I've been in the business since February 2008, working as an advisor and a portfolio manager. Among a few of my designations, one of them is a derivatives market specialist, which is not something that is widely held in Canada. But in order to achieve that, you obviously need to have a lot of experience and do a lot of different courses specific to derivatives. You may have seen me on the show Know Your Options, where I am the host. It's every 2 weeks on BNN on Wednesdays, which I'll touch on that again. Over the years, been a panelist at many TMX events, both in person and online, and just tried to be a part of the option education community for a long time. So my job here at Moat Financial, where we manage segregated accounts, is to work with clients to understand their needs, build strategies and portfolios around those needs, and then execute the day-to-day investments for them. But I'm also the portfolio manager for a new ETF, the Moat Active Premium Yield ETF, which is listed on the TSX and employs a lot of the strategies that we will be talking about here today. But a big thing that, the message that we're always trying to have within every presentation that we do is that we want to focus on simplifying options trading. There can definitely be, a bit of a cloud around options, that they're a bit more complicated. And, we want to make sure everything is simplified as much as we can so that people actually use them. Because if it's too hard, people won't use them. And we feel like it's something that investors should be using. So I mentioned Know Your Options. It's every second Wednesday on BNN at 3 p.m. Eastern. The next show is on February 25th. So if you like options, you can send in your questions and be a part of the show, and that's something we definitely appreciate. Okay, so as mentioned, we're going to talk about cash-covered puts. What are they? How can I use them? And then the benefits and risks. So we'll start at the beginning and talk about what is a put option. So a put option is different from a stock in that it's not necessarily, you're not buying an equity in something. It's actually a contract between two people. So this contract gives the buyer or the holder the right to sell a set number of shares, which each contract is 100 shares, for a set price by a set date. So that set price is called the strike price, and the the options expire on the expiry date. So this gives the person who buys that option the right to sell the stock anytime between now and when that expiry happens. Now, in exchange for that, they are going to pay a premium. So what we're going to be talking about today is actually selling that put. So we're going to sell those rights, but we're going to collect a premium. We're going to collect cash in order to make that commitment to buy the stock at a lower price. So we're going to dive pretty deep into that. And just a couple of terms that will come up throughout the presentation is in the money and out of the money. So an in the money put option is when the stock falls below that strike, and an out of the money put is when the stock is above that strike. Okay, so again, important terminology. If you're not familiar with it already, that will come up. So selling cash covered puts. Is it bullish or bearish? Are we the writer or the holder? And is it risky? So I'll answer these right here on this slide. So a lot of times when you hear puts, you think bearish. Okay, so somebody who's buying the puts, we'll get into why people buy puts, but it's often associated with bearish. But selling those puts, you are actually, it's a bullish strategy. It's sort of like you are selling somebody insurance on a position. So you are taking a bullish stance on that stock because you think it will stay above that level. And if it goes below there, you're happy to own it. So selling cash covered puts or cash secured puts is a bullish strategy. We are the writer. So we are the ones who write this option, and then somebody else will hold this option. It means that we are the seller, somebody else is the buyer. So we get the money for these options when that transaction happens. And then is it risky? Well, the measurement of risk on this is you are entering into, you're foraying into the equity markets. So you are exposing yourself to equity market risk. But we really like to highlight that this, because you've got downside protection embedded into these trades. So, there's a gap between where the stock is trading now, where you're committing to buy this, or the strike of the option, and then the premium that you collect. This is less risky than just outright buying stock. So the risk level lies lower than just outright stock purchases, which is important because that's something that a lot of us are used to. That's a risk level that a lot of us are comfortable with. And, there's, again, a bit of the mystique around options and misconceptions that if you're using options, it's adding risk. This, compared to long-only investing, is actually reducing risk. So talking about why somebody would buy a put option. So I guess the first simple answer is there's a lot of reasons, okay? But the simplest one would be that you want to take a bearish stance on an equity. So if you buy a put, that put option goes up in value if the stock goes down. So if you buy a put option and it goes down a lot, well, that option can make a lot of money. So it can be a leveraged way of making a directional bet on a stock down. So in addition to being able to make that directional, bet that stock will go down, it also has sort of limited liability. Because if you buy a put option, the most that you can lose is what you paid for that option. Now, if you're buying an out of the money put option, that will expire worthless if that stock goes up, stays flat, or doesn't go down enough. You need to get the direction right, the timing right, and the amplitude right. Those are three hard things to do on the buy side. And so that's why we typically like to be on the sell side. But the thing is if that stock's at $100, you buy that $90 put, and the stock goes to $500 a share, you only lose what you put into the buying that option. That's compared to a put option, shorting a stock where your liability and your risk is unlimited. So it's a way to say, hey, look, I think this will go down, but if I'm wrong, I don't want, to lose my shirt. The other one is hedging a long position. So let's say you're long a stock and you say, okay, this is going into earnings, or I've owned this for a long time and I'm a bit worried about the next X period of time, and you want to protect those shares. You can buy a put option. So as your stock goes down, the put will go up, and you can be de-risking that position by buying the put. So this is, I'd say, probably one of the more common ways that people use puts is to hedge those positions, to buy protection, to buy insurance for an existing position. So that's another reason. The other one would be a market maker. So this is who we actually probably are transacting with quite a bit, is on the other side, we sell these puts and there's somebody who's in the market providing bids and asks, providing liquidity that we're transacting with, and then they hedge themselves some other way. That's a whole other presentation. How they hedge themselves, really, quite frankly, I don't really care, because my counterparty is the Montreal Exchange and the clearinghouse, rather than the person who's actually transacting on the other side. So how they hedge themselves, not my concern, but that's typically a big player in who we're transacting with. And then other reasons, people do all kinds of things for all kinds of reasons. And so we could go on for an hour here, but those would be the main ones. So what's the process for selling cash covered puts, incorporating this into a portfolio? So the first thing, and always the first step, is we have to identify a stock that we like. Okay, this has to be an equity that you are willing to own for the long term. This starts with fundamental research. This starts with being willing to get long that stock, to say, look, if options didn't exist, would I buy this stock? And the answer needs to be yes, because if the stock goes down when you sell one of these puts, you will be forced to buy it. And so you don't want to be selling puts on something that you don't actually want to own. So step one, always, and I really harp on this because people can sometimes get lured in by big premium, which we'll touch on that as a potential pitfall within this strategy, but just don't get lured in by big premium. Okay, step one, identify a stock you like, then identify a price that you're willing to own it. Okay, so with that now, the cash covered piece of this means that we sell those puts and then we actually have the money set aside to buy that stock. So we are not using leverage. If we sell a $50 put, that's 100 shares. That's going to cost $5,000. We actually set aside $5,000 in order to buy that stock if it goes down. And so this is another way that we're sort of hedging ourselves, that we're not taking on leverage risk, where if we sell a bunch of puts that exceed the underlying value exceeds the money that we have, well, now we're setting ourselves up to be in a bad spot if the market declines and we have to buy a bunch of stock that we don't have money for. So we set the money aside, we buy money market or bonds. The next one is we take a look at the option premiums. So there we're going to analyze, okay, this is a stock that I like. This is the price that I'd like to get long. And what do the option prices look like out the next 1 month, 2 months, 3 months, whatever our timeline is that we're trying to set up. I think I just saw a note that Canada won the game. So hopefully that wasn't a trick. But yeah, we're going to analyze the option prices. And so we've decided we like the stock, we like this price. And if the option premium is going to give us enough cash or enough meaningful premium that we are willing to accept the risk of, committing to buy that stock at a lower level, then we sell those options at that price. Next step is we want to make sure we've got our math right. We already checked to make sure we're cash covered. So we check again, execute the order, and then check it one more time. Okay. Options obviously can, there can be some mistakes, and there's, every contract is 100 shares. So if you get a 0 wrong, there can be some multipliers that can be expensive. So it's better to catch that error right out of the gate. It only takes 2 seconds than to find out later. So what is a cash covered put? So we touched on this, but we'll build on it. Okay. So the seller of the cash covered put sets aside the money to buy the stock that they want to own at the price that they want to own at this, but they're at the price they want to own it, which is that strike price. So they sell that option. Now somebody's got the right to sell them that stock if it drops. And then we wait. Okay. We collect that premium. And we sit there and we wait for these options to decay, and we wait to see what the position looks like at the end. Is it below that strike? Are we going to have to buy it, or has the stock gone up, stayed flat, and the options have decayed? But day one here, we are just effectively saying, hello, other market participant, this stock is at a certain price. I'm committing to buy it at a lower price, and you're going to pay me for making that commitment. And then we wait and see what happens over the life of that option. So why would people use this strategy? Okay, so we talked about why people buy puts, and why would people sell puts? The number one reason is to generate additional income. Okay, so if I have cash and I want to grow that cash, I can buy fixed income, I can buy stocks and wait for them to go up or collect dividends, I can buy stocks and sell covered calls, or I can say, hey, look, I want to generate some additional cash in this account. So I'm going to sell people the right to sell me stocks that I want to own if they decline. So number one thing that people are doing here is generating additional income. If you look at the growth, especially in the ETF market, of covered call ETFs, it's been enormous. In the last few years, it's been the fastest growing area in the ETF space because people want that income. And this is another strategy that will allow you to take less risk than buying stocks and selling calls, but still generate some meaningful premium and meaningful income. The other way is this can help reduce overall portfolio volatility. So we'll touch on a few examples of how this is such a defensive strategy. But if you own a stock and it goes down 1%, your position is down 1%. If you sell a put option that is 10% out of the money and the market drops 1% or 2% over the life of that option, if you're still above that strike at the time of expiry, you actually make money. So the swings in the portfolio are not going to be as wide. So if your goal is to be invested to generate growth, but not be totally exposed to all the wild swings that we see every single day, which are pretty pronounced. I mean, the markets are up today, and we'll see what happens with a Fed announcement. That could swing things the other way. I have no idea what's going to happen, but volatility is reasonably high these days as there is so much uncertainty, and this can help you reduce that. Let's just say you sold a call option on a stock and it went up and you were called away. This is a way for you to re-enter that position. So let's just use a fictitious example. Stock was $45. You sold a $50 call. The stock went to 55. You were forced to sell that stock. Well, now you're sitting there with the stock at 55 and you say, hey, I'm willing to buy that stock back if it goes to 50. You can either wait until it goes below 50, which may or may not happen ever or for a longer period of time, or you can just sell that $50 put out a couple of months, collect the premium. If it goes down, you'll buy it. If it doesn't, you make a bit of a gain. So the one thing that is a little bit different with cash covered puts versus covered calls is the rules around them in registered accounts. So covered calls you can do in registered accounts all day long. You cannot sell cash covered puts directly in a registered account. So if you have money in your TFSA, RSP, RIF, that sort of thing, you can't say, okay, I'm willing to sell some puts to buy some stock at lower prices if they go down. You can, however, access this strategy by buying an exchange traded fund. So you do need to have that intermediary between you and the strategy of a fund of some kind, but those are available. And obviously I've mentioned that we run one that does this strategy. And part of the reason for us implementing that was for our own use, because we trade options for our clients all the time. But if we want to sell cash covered puts in registered accounts, we need to use a fund. The other one is that it accesses income on non-dividend paying stocks. So in this country, we have, a basket of stocks, banks, pipelines, telcos that Canadians have been buying forever that consider themselves income-oriented investors. A lot of times that means they'll shy away from either the higher volatility names or low or no dividend paying stocks that don't pay a dividend because it's not going to help them achieve those income needs. Here, you don't need to rely on a dividend in order to achieve your income goals. You can generate that income yourself by selling these puts. So just kind of comparing cash covered puts versus covered calls. I'm pretty pleased with this graphic and one on the next slide here. So how do these compare? So we'll talk first about cash covered puts. The gains from these trades come from the premiums that you collect and the interest you earn on the cash that you've set aside to buy those stocks. Okay, so you're not participating as the stock goes higher. So in a market where the market is rising quickly, this will typically underperform. But in an environment like this, where we've seen a very fast rising market over the last few years, where investors might want to be a little bit more cautious with some or all of their equity investments, this is a way for you to reduce that volatility and generate income and gains from the premiums you collect and the interest on the cash. This, compared to covered calls, has greater downside protection. So in this example, in this graphic here, if a stock is trading at 100 and we sell that $90 put option and we collect $2, we've got 12% of downside protection. So if we sell that option out 2 months and the stock drops 12% over that time period, rather than being down 12% like a long only investor would be, we are even. And now we're in a position where we can set that strike even lower to build in some more downside protection and move that out further and generate more income. So it really is a great strategy where anywhere above $90, this trade on this graphic will make $2, and that's a pretty good trade over a short period of time. So I mentioned that this will be lower upside in a rising market, but your trade-off is that you've got a much more defensive strategy. Mentioned that it's not available directly in registered accounts, but you can use exchange traded funds. This, unless the picks of the equities that you're putting in the mix here are, bad picks, this should outperform in down, flat, and slightly rising markets. Okay, so in the majority of market conditions, this should outperform. It's just that sort of fast rising market where this strategy will often not keep pace. So mentioned this is lower risk than long only, and it's not using any leverage. So we'll talk about this more, but in a lot of these covered call ETFs specifically, there is leverage that's put in there. And it's worked quite well over the last couple of years because markets have been rising. But this is a strategy that should remain consistent in how much premium it's generating, whether markets are moving up or down, because we're not using leverage. So the covered call side of the example we just showed, this here, you're getting gains from premium, capital gains, and dividends. So no interest because the money is not in an interest-bearing investment. It's invested in the stocks. But here, you've got the gains from premiums, but you for the other ones, the stock has to pay a dividend or it has to go up in order to generate those returns. So if the market's not rising, then that's not going to be activating the capital gain side. And if it's in some non-dividend paying stocks, then those won't be part of it. So I don't want this to sound like we're against covered calls. I just want to really highlight the differences here, that the cash covered put side just offers more. It's a more defensive strategy. Okay, so if you're a more cautious income oriented investor, this will make a lot more sense. So covered calls, they outperform long only in flat and declining markets and slightly rising markets. The greater gains will come from an appreciating market. So if you're of the view that the market might not rise like it has in the past, then this won't activate that part of the gains. And then we mentioned that a lot of the ETFs are using leverage, which in a rising market really helps, but it will be and have a negative effect in a declining market. So cash covered puts, is it a good time to use it? Yes. I mean, take a look at the biggest piece of what makes up option pricing is volatility. So the more volatile the market is, the higher option prices go. The more uncertainty there is, the higher option prices go. If we use just the VIX as a measure, I know that's a U.S. Product, but it's fairly widely known. We've been hanging around in the high teens and low 20s. That's elevated. Okay, so that means that's a measure of the implied volatility of a broad basket of options. And so you can get the implied volatility on individual names. So, if there's a sector that you like that has been quite volatile lately, chances are very good that options are going to be more expensive on stocks in that sector. The cash covered puts, markets are near all-time highs. If the market was down by half from here, valuations would be incredibly low. It might make a ton of sense to just get long and expect a big bounce. But here we are looking at all-time highs and just needing incremental gains from the market if you're long only. And this is a way for you to have access to the equity markets, have potential for equity market-like returns without taking all that risk. And then, options, we're just seeing more volume, better liquidity, and then better technology across a lot of trading platforms, more awareness. I mean, cash covered puts, in our view, is going to be that next big wave in the options market. Covered calls, I mentioned sort of 5 years ago, they weren't like a huge thing on the ETF space. And now they are the fastest growing segment. So in our view, the cash covered put side is going to be that next wave. And we think it's because it will make a lot of sense mathematically. So mentioned the intrinsic value and time value. So intrinsic value is the amount that an option is, or a stock is below that strike price. So the example here is if a stock is trading at $49, a $50 put has $1 of intrinsic value. So pretty simple math. You just subtract where the stock is from that strike. So this here would have $1 of intrinsic value. The time value, this is where we make our money. Okay, this is what we are selling. Selling intrinsic value doesn't make a lot of sense most of the time because it requires the stock to move higher in order for you to capture that. But the time value, that's something that we can sell someone the commitment to buy the stock from them in the future. And then over time, that option will decay. So to calculate time value, in any out of the money option, any value in that option is always time value. So if the stock is trading at 55 and that $50 put is $1, well, we know that the time value in that option is $1. If the stock is trading at $49 and the price of the option in the market is $2, we already calculated that this option would have $1 of intrinsic value. So we take that away from the price of the option in the market, and that's the time value. And over time, that time value expires or erodes. Okay. As you get closer and closer to expiry, there is less and less time. So that time value will run all the way to zero. And in fact, an out of the money option expires worthless and it just gets removed from an account after expiry. And it's like it was never there. But the cash that was collected, that stays behind. So we'll have a look at an example here. So look, this hypothetical company ABC, we've got the share price is $55. We want to sell a cash covered put at the $50 strike. So we like ABC, we want to own it, but we want to own it at $50, not the current share price of 55. So how are we going to do this? We want to sell a cash covered put. So if we look at the April $50 put option, that's 57 days from now. So call that 2 months. Market is $1.50 on this. So $1.50 is 3% of that $50 strike, but we've got the distance between where the stock is now and that strike price plus the premium that we will collect. And so our commitment is to buy $5,000 worth of stock, and we're going to get paid $150 over 2 months. So part of this process is to set aside that $5,000 in order to buy the stock if we need to because it declines. If we were to have $5,000 set aside and sell 2 put options, well, now we are very far from being cash covered. Okay, we have an obligation to buy $10,000 worth of stock. We've only set aside $5,000. So we want to make sure that we're maintaining our lower risk stance on these in order to stay cash covered and setting aside the amount of money that is going to be required to buy that stock. So day one here, we sell that April $50 put, we collect the $1.50 or $150 because it's $1.50 a share times that 100 shares per contract. We add this all to money market. So day one, kind of nothing happens, right? You sell that thing, you collect $150. You now have a short option position in your account that's worth negative $150. Your net position is going to be still that $5,000. We have to wait for that option to decay. The cash will stay constant and the time value of that option will decline. And that's where we make our money. So the maximum profit of this trade is actually not the $150. It's $175.40. So even though interest rates are low, it does make an impact because we're going to be putting away that $5,000 plus the $150 and generating a bit of a return calculated on the next slide. So we're actually not just making 3%, we're actually going to make more like 3.5%. And our downside protection here goes all the way to $48.50. So the stock when we started here was 55, strike was 50, but because we collected $1.50, our break even is actually $48.50. So you've got this big gap before we would start to lose money. And compared to long only or even a covered call strategy, that's a bigger window. and makes a big difference if markets are choppy. And then the last thing is just as expiry approaches, we just keep analyzing the position, see what it looks like, and see what we want to do, because our wins on this come from doing this repeatedly. So mentioned maximum profit was 175.40. That comes from 51.50, the $150 that we made in the option premium. Invest that cash in money market at 2.5% for 57 days. That generates $20.11. Looks like I might have made an error on this slide, so apologies for that. I think I first made this slide when rates were a little bit higher, but either way, this is over that 57 days, actually about a 23.9% annualized return when you compound that for the fact that you'd be able to do this 6 times throughout the year. So we've talked about what we do at the onset. Day one, what the market looks like, what the share price is, but we're making a commitment in the future where there is a little bit of uncertainty. So what do we do at expiry? So in that example there, the stock was 55 day one. We sell that $50 put. At expiry, there's really only 2 places this thing can be. It can either be below 50 or above 50. So if it's below 50, we can do one of 2 things. We just do nothing, and we will automatically be assigned that stock. So options automatically exercise if they are in the money at expiry. So even if that stock is $49.99, we do nothing as it expires on the Friday. We wake up Monday morning and that stock will be in our account. Or the other thing that we can do, and this is something that we do quite often, is we roll it to another month. So that will involve buying back the put that we sold that now has no time value and will trade just for its intrinsic value, and sell something further in the future at the same strike but has more time and therefore time value. So we will generate a further credit. The stock is above $50, then we can just let that option expire. We made $150, and then we can look to do that again, depending on where it is. Maybe we have to move the strike up. Maybe we can move the strike down. But our obligation to buy that stock at $50 will disappear after expiry if this thing finishes out of the money. And then the other option is to buy it back a little bit early or roll it out to another month. So here's a rolling example. So in that example, we had sold that $50 put for $1.50, and when it was 55, now it's dropped $6. Here we are, it's option expiry day, and the stock is $49. So if we do nothing, this stock is going to get put to us. We will have a net purchase price of $48.50. The stock's at $49. We're still in a bit of a winning position, but maybe we say, hey, I don't actually want to own this right now. So let's roll this out into the future. Let's kind of keep the trade going. Stock's 49, no time left, should be no time value. We buy that put back for $1. That's the April. And then we look out to June in this example, which now that $49 stock, that the $50 June might be trading for $3. Okay. So there could be $2 of time value. So if we buy one back for $1 and sell the further dated option for $3, that generates an additional $2 credit. And then again, we just wait. You're going to want to make sure you're entering these as a spread trade, okay? A spread trade is where you are going to buy and sell simultaneously, and the order is entered for your desired credit. So you say, I'll buy this one back and sell this further dated one, and I want $2. I don't care if I buy this one for $1 and sell that one for $2, or if I buy this one back for 1 cent and sell this one for what was that, 1 cent or 201? Like, you don't care what the actual prices are on either side of that, as long as that goes in at $2 net credit. And if you don't get filled, it won't fill one side or the other. It'll only fill both sides or no sides. And then you can, if it's not getting filled, you can lower that desired credit, 1 penny or 2 pennies at a time until a market maker will transact with you. And that really prevents you from all of a sudden getting filled on the one you're selling. Now you're short the one for this month plus one in a future month, and then you're panicking trying to buy back that option that you sold. So just looking at, a few potential pitfalls here. The first one we talked about at the very start, like don't get lured in by big premium. You can Google, highest implied volatility stocks, and there is some crazy stuff out there. If you dig deeper on some of those, a lot of them are, biotech stocks or tech names or something that, this thing, if it's trading at $20, it might go to 40 and it might go to zero. So those can be incredibly expensive options, but you cannot lead into the trade with really expensive options. I mean, I've seen it in my career. I've been lucky enough to not fall into this trap, but definitely heard of some horror stories where someone's like, okay, the stock's $20, I can sell this $15 put for $3, and I just need it to stay above 15 for 10 days and I'll make 20%. And a lot of times the market knows more than you, and next thing you know, you wake up and the stock is $6 and you're in a losing position. So make sure you start with that first step that we talked about, which is owning stocks that you want to own for the long term, which is actually the next point. So make sure you are filling your portfolio with names that you're happy to own. If there's talking about like Warren Buffett, if the market was turned off for 5 years, would you be okay holding these names? And make that your starting point for building out a portfolio. Don't oversell. So we want to be cash covered. So just make sure you've got your math right all the time, that you're the underlying, if every stock got put to you, you've got enough money to buy that. Otherwise, you are using leverage, and that can feel good when things go well, but will really feel not so good if things go against you. And the other, I don't even think this is a pitfall. I mean, a lot of people who want to be involved or active in their portfolios is the ongoing maintenance, where these options will expire. You sell something out to April, well, at April expiry, you need to be paying attention in order to adjust that position or see how your portfolio is changing. So this can be something that people oftentimes don't really want to have, that maintenance of picking stocks, picking strikes, rolling options, all that. And so that's where people might look at a money manager or an ETF. So just a few last thoughts here. Success in this comes from repetition. It's the repetitive nature of this, where if you collect 3% selling a put option, obviously you're not headed straight into retirement with that one trade. But the example that we used that generated 3%, well, that was going to be happening multiple times a year. So it's the fact that you sell these options and then you sell them again and again and again. And it really, use a baseball analogy, which I wish I had a hockey one with what was going on right before this. A baseball analogy would be base hits, okay? This strategy hits no home runs. This is not a home run strategy. There's no triples. There's not even really any doubles, okay? We're hitting singles over and over and over with the occasional, we'll steal second. So it's really just doing this trade multiple times a year. And it is very impressive how these things add up. If you've been selling puts and calls for a few years, and you're collecting, $400 here and $900 there and all this, those can seem like small amounts, and then you add them up after a few years, and it's like, wow, I generated an enormous amount of premium here and really did myself a big favor by incorporating options into a portfolio. Take a diversified approach, so have laddered expiries, so don't have everything expire at the same time. Have multiple sectors, don't just put everything in tech because those things will often trade together, so you'll be winning and losing across the board at the same time. Sell some low volatility options. That's okay, and then mix in some of the higher volatility ones in order to balance out the overall net premium that you collect. But don't just pile in all the high volatility, in my view. And then you can include stocks that pay dividends and don't. So if you're an income-oriented investor, you don't have to focus on just the high dividend paying stocks. The next one is, if the premium is too low, don't bother selling the option. That's one thing that we definitely see in some products out there, where the managers are told this is your basket of stocks and you'll sell options this far out of the money and this far into the future, and regardless of market conditions. But if you're taking this into your own hands, you've got the ability to decide whether or not you will sell that option. There's one other thought that wasn't on here, is for some of these bigger US tech names, which are very popular in the options market, but a lot of them are really high priced stocks. we have some great products in Canada now with these CDRs, Canadian Depository Receipts. So, an example I did on the show one time, I said, hey, sell a put on Costco. Well, 100 shares of Costco in the US at $1,000 a share is 100,000 US dollars. Convert that to Canadian, 137,000 Canadian. Well, I got a call from a viewer who said, hey, look, maybe I don't have that kind of money to allocate to one position. Well, on a Canadian CDR, I think their version, which is just a Canadian hedged version of Costco, and then it would be partial shares, is I think around $45. So you could sell a put on Costco, get that exposure for 4,500 Canadian rather than 137,000 Canadian. So there are more of these products coming out to give people access to these different things. The Montreal Exchange has been innovative with these, and it's just continuing to grow. I think last week on these CDRs, I think 7 more just started trading options. So this is the stuff that just keeps getting better and better over the course of time, and we hope that more people are using options as we've described. So. Well, I had one more slide and I jumped the gun. I thought the question slide was coming. So looking at cash covered put ETFs, some of the pros, you get access to the strategy. You can do it in registered accounts. You don't have to do all of the work of selling the options and rolling them and doing all of that. You get a diversified portfolio within just one purchase rather than building the whole thing out. And I mentioned, we think that this is the next big wave in ETFs in Canada, just following suit on the covered call side. The cons are, take a look at what they own. So most of these cash covered put ETFs, I won't say all, but I haven't found more than one that actually incorporates Canadian names. And so if you want to have exposure to Canada and not just basically the Mag 7, make sure you understand what they're trading in that portfolio. Understand what their trading mandates are. If it's very strict and might actually have them trading options in a way that you don't like or don't want them to in certain market conditions, just make sure you understand that. Because they can have limited flexibility. These managers are told, look, here's a pot of money and this is how the prospectus says to invest it. So invest it this way. And sometimes with an ETF, they're owning a basket of names or trading options on a basket of names. You might own some things in there that you don't want to own. So, the way to mitigate that is to understand clearly what the ETFs own or trade these options yourself. Okay, there's the question slide. I'll in a second here turn it back over to David, but we're always interested in hearing from investors, whether it's calling in to know your options or booking a meeting with us. We want to just continue to spread the good word about options, and so feel free to reach out. You can book a meeting through that link. How options are a wasting asset and they decay over time. They decay more rapidly as you get closer to expiry. So we're not, going crazy and selling options every week or every day or all that. We typically will have a balance between sort of 1 to 3 months with an average of maybe a bit less than 2 months, because that's where we see on the curve on average getting good returns. So pick a stock you like, find a level you want to get long, and then just make sure that at that level, that option, that you'll get paid enough for making that commitment.
Great. Next up is, what is the difference between US and Canadian markets when selling cash covered puts?
So, the difference in sort of trade execution and everything, it would be the same as far as, you look at where that option is trading and, there will be the bid and ask, and then you transact somewhere in between those. I think, I'm on a Montreal Exchange webinar here, and, this is often something that I've built an entire career on selling options, mostly in Canada. And a lot of times people will have a misconception that liquidity in Canada is just not as good as the US. And you know what, in some cases it's not, but a lot of that actually has nothing to do with the Montreal Exchange. It's the liquidity of the stocks that underlie those securities. So if you have good liquidity on the stock, whether it's in Canada or the US, you should have good liquidity on the options. So Apple in the US trades like a bazillion shares a day. The options can be at a 1 cent spread, and that's easy. You find some stock in the US that trades 300,000 shares a day, the option liquidity will not be the same as Apple or Nvidia or one of these types of names. So really try to make sure that you're actually more comparing the volume on the stock or those options, and not just so much saying, oh, this is Canada or this is US, so this is my overarching view on that. So yeah, I guess the difference is nothing other than the currency, but the real comparison will be on the stocks that underlie those options.
What is the delta value when you sell the put?
So that's an interesting one. I mean, the Greeks, that's a whole other presentation, perhaps one coming up in this series. Some people really rely on the Greeks and say, I'll never sell anything, higher or lower than a 20 delta. For us, that's not so much what we look at. We look more at what are we getting paid for the option and how does that compare to the price that we're willing to get long that stock. So let's say a stock is $45 and we say, look, we're happy to own this at 44. It's already come down from 65 or something. Maybe we'll sell it close to the money and that option could be closer to 50. And maybe there's something else that we're like, okay, we want more downside protection on this particular name. And it just so happens we're going to get some meaningful premium from selling that. So delta is something that we will look at sometimes, mostly to sort of calculate where we think an option will get to if the stock drops $1 and say, okay, we're going to sell, the $40 put. And right now the stock's 50 and the option's only 20 cents. How far does this have to go for that option to be 50 cents? That's where we'll use these deltas to calculate what needs to happen before we sell it, and not so much just say, oh, that's a 20 delta option, so I'll sell it. So, but yeah, I think this is an excellent segue into a future presentation.
Agreed. Next up, so long question. So do we have to have a margin account to utilize those strategies, although we have sufficient funds to execute the trade? This individual is saying his bank isn't allowing him to do that without a margin account.
Yes. In order to sell cash covered puts, it needs to be a margin account. So you may invest in a disciplined fashion that makes you cash cover. You will always have enough money to buy the underlying, but the actual margin rules and the execution and all that, they don't say that you have to be cash covered. So they want to make sure that you have the ability to borrow in the event that the stocks do decline and you don't have enough capital to cover that. And that's the reason why you can't do these trades in a registered account, because it needs to be a margin account and you can't do that in a registered account. So
great, thank you. What is the one major advantage and one major disadvantage of using a put instead of a simple limit order?
So the big advantage is that, I guess, will be twofold. One, you get paid. So both of these trades, you're going to make that commitment to say, okay, I'm going to buy this stock, if it gets to this price. So by selling the put, you get paid. So if the stock never gets there, then you still get paid. And then you might be able to get paid again and again and again. Whereas if you are just saying, okay, stock's 55, I'll put in a limit order at 50 and then just wait. The stock might never go to 50 ever again. You might be sitting there for a decade, or it might take 6 months, at which point you could have collected that premium a whole bunch of times. So I guess the difference, on a limit order would be that, if you say, okay, I'll buy this if it goes to 50 and you wake up one morning and the thing opens at 40, then you'll get filled at that level. But, quite frankly, you're making the same commitment, right? You're saying if this stock goes here, I will buy it, but in one hand you get paid and in the other you don't. So to me, that's a pretty easy choice to take the one that you get paid for making the same commitment.
Great. Next question is, what do market makers do? Do they manipulate any stock prices?
So I don't believe market makers are out there manipulating stock prices. Their main thing is to provide liquidity to the market. I think, over the course of time, there's been misconceptions over a lot of things. I think some of them are market makers. I am not a market maker. I've never worked as one, but they are definitely a tool. If there were no market makers, liquidity in Canada and the US on stocks, on options, on most things would be much worse. So a market maker, they are there. They have their systems, whether it's an equity or an option, to calculate this is what the net asset value of this security is, and then they collect a fee from the exchange or make money through their trading strategies to provide a bid and an ask. Okay, so if they think something's worth $1, then they say, okay, this is worth $1, so I'm willing to buy it for 95 cents, and I'm willing to sell it for $1.05. And then if someone they're sitting there waiting, providing that liquidity at all times. And then if somebody comes along and in an instant says, I want to do it, they can transact. Then that market maker needs to sort themselves out to hedge themselves. But I do not believe that this is market making is a system for manipulating stock prices.
What is the best platform to access option volume?
So I mean, for Canadian options, you can access all that on the Montreal Exchange website. I think everything is delayed 10 or 15 minutes, but the volumes, the open interest, the bids, the asks, last, all of that is in there. And so yeah, for Canadian options, that's what I use when I need to access something and I'm not at my terminal. I'll definitely be looking at that. And then if you've got a trading platform, an online brokerage, or you've got a broker, then they would obviously have a paid for system for accessing that.
What stocks do you suggest doing this strategy for?
So I won't pick off a bunch of specific names here. I think if you look at what we hold in our ETF, you can see some of the names that we do recommend specifically. But it's got to be a basket, in my view. I mean, if you're looking for long-term success, you need to take a diversified approach. I mean, if you want to try to shoot the lights out, this is probably not the strategy for it. So not just trying to concentrate in one sector or one volatility level. I think have a diversified basket, own stocks that you think are good value that will go up over the course of time, and have good, economic moats around them, and build it out that way. But yeah, for specific names, you can always access on our website what names we've done, or you can tune in to Know Your Options every second Wednesday, where we always make 3 trade recommendations. So
I'll follow up with this one because it's a similar question. Which ETF do you recommend?
So, I mean, on the cash covered put side, I mean, obviously we recommend our own. This is a new ETF. We, came to this ETF because we felt like this was a big gap in the market, something that incorporates cash covered puts as the main strategy and incorporates Canadian businesses and Canadian options that it just wasn't available widely in this country. So on the cash covered put side, there are a few others, but in my view, which is obviously biased, these are mostly using large cap US names, and unless you want exposure to just that, then you need to look for a Canadian alternative, of which there are not that many. And I think chicken and egg on this, like, we developed this because we felt like it didn't exist, so that we're not just recommending it after we came up with something someone else already had.
This next one, you touched upon this on the presentation, but maybe just to summarize it for the group here. Why might a Canadian investor choose to sell a cash covered put on the Amazon CDR instead of the actual Amazon stock on NASDAQ?
Yeah, so I mean, the biggest thing will be the position size. So obviously Amazon, say you're selling that $200 put, each contract is $20,000 US dollars. So convert that to Canadian, you're looking at close to $30,000 for one position. If you've got the capital that is not, sort of dominating your portfolio, then go ahead. That makes sense. The other one is it removes your currency risk. So sometimes the question will come up, hey, if I'm selling puts, if I'm a Canadian investor and I'm selling puts on US stocks, should I be setting aside US currency in order to be my cash covered portion of that? So I can tell you from experience, sometimes you sell those puts, the stocks go up, but then all of a sudden the US dollar goes down and you're like, hey, why is my net position here going negative over this period? Well, it's because the US dollar is weakening. So you can reduce your position size and you can reduce your currency risk by going with a Canadian CDR, by having that at home, and then they take care of the currency balancing for you.
Great. What probabilities to use for profit and likely to touch the strike price?
Sorry, what probabilities
to use for profit?
I guess I don't really understand that one. I mean,
Okay.
the reality is we just look at really simple math. If you are selling an out of the money put option, the majority of the time it will expire worthless unless your picks are really not good. If the stock goes up, it expires worthless. If it stays flat, it expires worthless. If it goes down a little bit, it expires worthless and would only be in the money, on a move that exceeds the distance between here and the strike. So, I would say the probability that it expires worthless is much better than 50%, if I understood that question correctly.
Great. For that ETF you were referring to, what percent is Canadian options and what percent is US options? Are there any positions or options in any other countries beside Canada and US?
So for the Moat Active Premium Yield ETF, it's about 60%, maybe 65% Canadian, 30 to 40%, 35 to 40% US. It's North American listed only, so we obviously could incorporate some US listed ADRs for a European company, but at this point, we are just North American stocks.
Someone did ask, what is the ticker for your cash covered put ETF?
It's MOAT, Moat.
I think we answered this one. How do you get up-to-date quote? What platform do you provide this information? I think you covered that it's mostly on the Montreal Exchange.
And then the other one too is that you can go to, let's say you're looking on the Montreal Exchange website and it's delayed. Obviously, then you can actually go to money.tmx and get the live quote from there. And so if the quote on MX is on the Montreal site is, if the stock was 50.25 and that's the current share price, then you can expect those option prices should be pretty close, or you can look. But I would assume that if you are trading through a platform, that it must be providing you with that. Otherwise, it might make sense to look at another. And I don't really have an opinion on which online brokerage is the way to go.
Great. I guess last question, since we have 1 minute left, any brokers do you suggest for the ease of executing or trading these strategies?
Yeah, so I've never used an online platform myself. I think some are definitely better than others, and I think a pretty short amount of homework can give you a lot of those answers. I think looking on some platforms online or where community platforms where people will give opinions on stuff. There's definitely, obviously, a lot of this industry is dominated by the Canadian banks, and all of their online platforms are not created equal. So I think a short amount of research will get you the answer you're looking for on that one, but I can't give it to you.
Okay, great. So that's all the questions we have. And that's all the time we have today. On behalf of the Montreal Exchange, I'd like to thank Chris Thom for sharing his expertise, and thank you all for taking the time to join us. As mentioned earlier, a replay will be available on our website, and you can find additional educational tools and upcoming webinars in our options education section. Once again, thank you, everyone. Bye-bye.
Thank you.